Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Long Verticals and Diagonals. And today we're talking about risk management, and specifically we're going to be talking about avoiding a scenario that may actually lead a trader to sell hundreds or even thousands of shares that they don't actually own. Didn't even know that was a risk. Yeah, we need to talk about that. We're going to be talking about trading long call vertical spreads today, and a kind of an insidious, little bit potentially enormous risk that sits there waiting in the wings for us at expiration. So I think this can be a great discussion. Before we can get to any of those details, though, let me first of all say hello to everybody who's chatting in out there in YouTube. I always like to see those familiar names. Hello there, Rick and Janelle, Dragon Rider, GBS, PR451, Ricebird, Grant, Debbie, Sharon, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream has concluded, we'll enjoy that recording, but be aware that you're invited to join us in the live webcast. This webcast streams every Thursday, and we start promptly at 11 Eastern time. We'd love to have you here in the live stream audience. Now, as a special treat for my live stream audience members, my very good friend Kevin Horner is going to be hanging out in the chats on YouTube. He's going to be addressing any questions that I can't get to just during the natural flow of the presentation. So thanks for having my back there, Kevin. And Kevin and I would also like to issue an invitation to everybody listening. If you have an account on X, you should be following your favorite presenters from Schwab on X. You can find Kevin there on X at Kevin Horner CS. You can find me there at Cameron May CS. But let's get into this very critical discussion we're going to be having today. Now, as we do, since risk is the focus, let's have some risk disclosures. This is important information, so please bear it in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including loss of principal. So with that important stuff accomplished, let's talk about risk. So here's what we're going to be addressing today in today's video. First of all, this video or this webcast is one in a series of ongoing webcasts. So we're going to be following up on currently existing paper money example trades, just to see if there's anything that needs to be done with those. And I think there's at least one that needs our attention today. Then we're going to look at the markets very briefly to sort of set the stage for a trader who's putting on a long call vertical spread. But I wanted to focus on some inadvertent risks that the trader might be taking in placing what appears to be very innocently a small risk vertical spread. And then we're going to talk about mitigating this unrealized or maybe unrecognized risk. And that is, that trader might wind up selling shares of stock that they didn't intend to sell, potentially even shares that they don't even own. So how might we mitigate that risk? Well, we're going to be placing an example trade with an exit attached to try to minimize that risk. Okay, so let's get right to it. Let's go to the Thinkorswim desktop trading software platform. Right now we have 4 example positions. Let's start here with Gilead. So with Gilead, we have a long call a long call diagonal spread. Now, as I say this, I have to apologize to somebody who chatted in before the webcast started. I was kind of chatting with everybody, and I saw Ray said, "Hey, do you ever talk about leaps and selling calls on those?" And I said, "Yeah, we talk about that, but not today." Well, that's not entirely true, because we do have some of those positions, and we're going to be talking about those positions right now. So yeah, we're going to talk about it. It's just not the focus of today's discussion. But yeah, in this case, we own a 623-day long call with a $95 strike with the preference for the stock to go up, helping out the value of that call. Now, against that, we've sold a 15-day now. Actually had more days on it when we sold it, but a 15-day contract at the 120 strike. So the real preference is for the stock to go up, help out our long call, but to stay below that 120 short strike. That's the best case scenario. And you can see right now, it's sort of doing that. The market value of the stock is at 109. That's below 120. But here's what actually has been going on with Gilead. That long call we purchased quite a while ago. Purchased back here at the end of January. And the stock has been up and down since then, but mostly up. Now, along the way, we've sold short calls against that position. We're in this current short call right here. So we've had some gains on those short calls. We've had a couple of losses on those short calls, but the long has really done pretty well. However, recently it's been struggling. You can see a stock is coming down. Yeah, it's staying below 120, which is good for the short, but it's doing some significant damage to that long. And we had a plan here that we initiated about a month ago. If this support breaks, this trend is now under threat, potentially. And so maybe we consider selling, and there we've broken that support literally as of this morning. I think we're going to close out this trade. So yeah, we've taken some profits here, some losses here. As of the current position, we're up about, what's that? Let's do some rounding here. It actually doesn't even require much rounding. Up about exactly $8 on a $15, $16 investment. That's about exactly 50% that we're up on that long call. And the current short call, we're up about $1 and change. So net about $2,700 of additional profit on any realized gains or losses to this point. So let's close. I'm going to close this one out because of that break of support. This is a net bullish position. The short call is nice. The long call currently getting hammered. So let's try to preserve what profits we can. I'm going to right click here. Let's create a closing order and sell this diagonal spread, exiting it. So we're going to get out of all three contracts. Looks like we might be able to do that for a net around a 2360 credit. There's a pretty good spread between the bid and the ask. How about we split that difference? I'm going to move this over closer to not the bid and the ask, but the mid and the natural. In any case, let's move closer to offering to exit at just market price and see if we can get out. Anytime we enter a limit order, though, there's a risk the order might not fill. But here we are looking to sell. This is to close. There are commissions to close out. That would leave us with a net credit if we're able to close at a minimum $6,986. Let's send this order off and see if we can get, oh, look at it, immediately filled. Sold out. Okay, so we have now a nice finished realized gain on Gilead across all those trades. Good trade. Next up, we have Alphabet. So Alphabet, currently, we're in another LEAPS contract. This one was a LEAPS contract when we entered it. Now there's only 106 days left. This has made the transition, the magical transition across that threshold. No longer a LEAPS contract. Oh, no. That doesn't really mean anything. LEAPS, long-term equity anticipation securities, is just a fancy term that we give to a contract that's long-term. I don't assign any more or less importance to it than that. It's just a name. Nothing has changed aside from this is now a shorter term contract. But in any case, preference is for the stock to be going up, but to stay below 265. And right now it's at 244. This call that we sold for 365 would cost us about $1 to buy back. The call that we bought for $25 is now worth about $68. So now about a $44 unrealized gain on this one. So let's go have a look at it. But here's what's happened with this one. Bought two contracts originally. We've already closed one of those out for a $50 profit on a $24 investment. So tripled our money on that one. Made a small profit on a short call here. This one, though, we took some lumps on some short calls and went way in the money. So we have a $50 realized gain against a $33 realized loss on one of these contracts. So still about an $18 profit. The second contract, though, we closed out for $33 loss. Now, as we just saw, we're up about, what was it, $40 on the remaining long. So it's still doing just fine. But trader might want to decide, we still have 108 days left. If we want to see the current short call that we're in, there it is. So we're well below that. Still have some time to expiration. I'm not going to be doing anything with that one. But maybe just like with our Gilead, maybe the trader should have a plan for when they pull the plug on this bullish trade, especially as we're creeping ever closer to the expiration of that long contract. So as long as we think the stock is likely to go higher, maybe the trader just sticks with that long call position. But here's what sort of stands out to me. Now, not every trader is going to see the chart this way. Recently, we had a gap higher, and then we ran. And when we run up sharply like that, sometimes we expect a bit of a pullback, or a technical trader will commonly expect a pullback of somewhere on the order of maybe, this is sort of a typical interpretation of a strong move up as profits are taken, maybe somewhere on the order of a third to a half of those profits are surrendered as profits are taken. Let's use a fib. Let's go to the top of this up move, click there, move to the bottom of the up move. And it's interesting where those lows settled in, right at that 50% mark, starting to gain strength. But I'm going to make a plan here. If we break down below this Fibonacci, that's our that's about a 2/3 retracement from this recent high. Yeah, it looks like a flag, Naresh. It could be. That doesn't guarantee the prices are going to go higher. So we're initiating a plan to manage that diagonal spread. Let's put a note right here. Consider exiting if fib breaks. There we go. I'm going to leave that right there. I'm going to edit the properties of that just because I like to have things matchy. And let's switch that to blue. There we go. All right. So, but for now, we're going to leave that trade on as it is. NVIDIA is a long call vertical spread that we just placed. When was this? This was a few weeks ago. So there's still 15 days left on these contracts. We paid a net, looks like about $4.15 for a $5 wide spread. So we're trying to increase our $4.15 to a $5 value. And what is the value right now? It's about $4.80. Pretty close. What's been going on with this one? With this one, bought the 160 call, sold the 165. Trader preference would be for us to be above 165, and look at where the stock is right now, 189. So let's go have a look at that. Let's see, this was our NVIDIA position. There's our 160 long call. There's our 165 short call. We entered this trade right here. The stock pulled down a little bit, never got below the short, then started to rally, and you can see doing quite well. So we could exit with most of our maximum theoretical gain at this point. The trader might also be looking and saying, well, we are so far above that short strike. Even if we pulled back at this point, we're most likely going to wind up right where we need to be at expiration. With this one, I'm gonna roll forward on that assumption. Let's let these probabilities continue to play out, see if we can continue to make money on this trade. Not a lot left, not a lot of juice left there to be squeezed, but I like having these discussions of making these sorts of decisions. Right now, there might be $20 per contract left out of a $500 trade. So there's 480 of risk with a $20 remaining reward potential. I'm using some estimates there, but I think we're going to leave this one on. Ambrose says, how can I add a short leg to an existing long call? All you have to do is sell it in the same account, Ambrose, and it automatically pairs up. Okay. Finally, we have United Healthcare. This is our. Actually, I shouldn't say finally, because there's one more we need to review. So this is another long call diagonal spread, though. $300 long call, 360 short call. We'd like to be rallying above 300, but staying below 360. And right now we're at 347.52. UNH has a bit of a has a little bit of a ways to go before expiration, but we did this trade on an inverted head and shoulders, coming off what we'd call an island gap reversal. If you're not familiar with these sorts of strategies with charting, if you want to brush up on that, you may want to check out my Friday webcast series called Advanced Charting Techniques. But in any case, it looked like we'd popped up through a neckline here, bought the 300 calls, sold the 360, and then it's been doing just what we might hope. You notice it's kind of worming its way up, getting closer to 360, but still out of the money on the short, in the money on the long, improving things. And right now, Trade's doing just fine, up about $700, so I'm going to leave that one to work. Oh yeah, Mary Burns says UNH has been unfriendly to Cameron. Exactly right, Mary. This looks like it's a great trade, right? So far, so good, but UNH was the worst trade of the year before this. Yeah, we did a long call diagonal spread that just got massacred. So notice I don't hold it a grudge against stocks. If the signals are there, the trader might go right back in, not revenge trading. It's measured just normal trading according to a trader's rules. Anyway, there is one other position, though, that's not reflected in current positions that we had last week is no longer here. It's because our trade from last week, which we intended to be short term. If you missed last week's trade, we were going to try to squeeze in a quick bearish trade in this very bullish trend, or very bullish market, and we did it. So here's what happened. Here's Tesla. You can go back. If you didn't see previous webcasts, by the way, do yourselves a favor. If you haven't subscribed to our Trader Talks channel, just do that right now. You can go down the lower right-hand corner, click on the subscribe button. It only takes a second. It doesn't cost anything. But our Trader Talks channel on YouTube is where we house our playlists of previous webcasts. You can join the live streams here as well. But like if you go to the playlists and go right on down toward the bottom, we have lots of different webcast series. Through no fault of my own, mine is kind of buried down here at the bottom. There's long verticals and diagonals, so I can click on View Full Playlist. And there was last week's discussion, trading short-term bearish moves in a bullish market. If you want to go back and watch that, you can see us placing the trade. You can see the plan for the exit. And here's what happened. This one was close. Let me zoom in. So we bought a 445 long put, sold a 440 short put, creating a long put vertical spread, preference for the stock to go down. And we did that right here at the top of this red candle. Well, we did go down, and actually the next day with a combination of price movement and time decay on a very short-term trade, we closed out in a 95-cent profit, and it looks like just in the nick of time. So we actually had an order in that just filled. That 95-cent profit, I think it was a $3.40 trade. So that was about a 28% return overnight. Pretty good trade. But boy, it could have gone differently. Just with a little bit worse timing, with a little bit more aggressive profit requirement, we may not have gotten there. And it could be a very different story, but we closed that one out. That was done. So that's it for our existing positions. Let's talk about planning and placing a new trade, but I'm going to do a trade that on the surface is going to look like low risk, and so therefore it might tempt a trader to take a a consistent position as far as risk is concerned, but expose the trader to even more risk that they may not anticipate. I know I'm teasing you, but I'll explain it. Anyway, let's go to the S&P 500 first. Is there a lot to talk about here? No, not really. Yes, we're down a fraction of a percentage point today, but literally coming off all-time highs again earlier in the trading session. So could we pull back a bit? Yes. Could this be a major reversal point in the market sell-off on a long-term basis? That's a possibility too. But let's just say that our trader sees this as, all right, maybe it's going to be another few days down like we've seen here, like we've seen here, like we've seen here, and here, and here, and here, and here, and here. So yeah, you get the point. Let's just say that our trader thinks maybe this is what the future holds in the near term. Maybe we pull back, but then we just continue to climb. So with that outlook, we're going to be planning and placing a new bullish trade. Now, I'm not saying that this is the correct outlook. I don't know the future. So we'll see what actually happens. But let's just say that we're that trader who has that conviction. Maybe a little bit of short-term choppiness, but moving upward generally. So I'm going to shift over. No, I don't want to go to Trade tab. I want to type in the symbol here. Let's use ExxonMobil as our example today. Let's say that our trader is just planning a trade somewhere, over the next few days to the next few weeks. Maybe they're keeping an eye on this earnings announcement and their preference is to not trade over that earnings. Let's keep that variable out of this equation. So I'm going to plan a trade that's done before October 31st. Okay. But let's say that our trader sees that ExxonMobil's been making its way higher, running up and pulling back, running up and pulling back, and running up and pulling back. And it looks like the last couple of pullbacks, even this little one right here, have found a good price floor right there around 112. So maybe they're fairly convinced that our stock is set to go higher as we move toward that earnings. Let me end that line before we hit earnings. So let's plan a bullish trade somewhere to conclude before then. Now, before I go plan that trade, I think it's fair for me to explain how I chose this stock. So what's going on in the mind of some traders as they're going through the process of elimination to choose a trade candidate? Well, they could have sector convictions, which sectors look strongest to them, which companies have the strongest fundamentals in their view. But some themes that tend to be fairly widespread are, number one, price per share. Number two, liquidity, heavily traded stocks with liquid options. Number three, using charts. Not everybody uses charts, but if we do, maybe that trader is looking for something that looks bullish. So there's sort of the backdrop for how I chose ExxonMobil. Okay. But I'm going to put on a long call vertical spread. And how about we do that on this technical evidence? What if we set up a long call vertical spread? And I think there's an expiration on the 24th of October. Yeah. So let me draw in a line here for the 24th of October. That's going to be before, we don't need this line anymore. Let's remove that one. That's going to be before that earnings announcement. So this just represents, that's going to be the time frame of our trade. At the longest, but that's going to be a critical part of this discussion. And I'm going to set up a trade, maybe with the stock possibly at a price floor right there at 112. Let's say we set up a trade that's going to work out optimally. It's going to be in its optimal position if we're just at or above 111 at expiration. So all we're asking the stock to do is to be somewhere up here as we get closer to expiration. Doesn't matter where, just higher, just higher than 111, right? So here's what our trader is going to do. Let's go to the trade tab. Let's go to the 24th of October. Let me set this to show all the single strikes so that we can see them all right there. There's the 111. I'm going to keep this a very narrow spread. Let's go for 110, 111. So let me draw that on our chart. 110 is right here. We draw in a line right there at 110. Oh, I don't want another. Actually, that's fine. We finish drawing in that box, because that's going to be our no-fly zone box. There we go. Let's make that one red. Go. But this can be our other strike right there around that 110 level. That's going to be our long strike. So here's going to be our trade, and maybe it's helpful when we map this out off to the left. So our example trade, not example, is going to be a long call spread. And for this example, we're going to buy the 24th of October 110 call. That looks like that's trading for between 370 and 385. Let's say it costs us, I don't know, let's call it 380. Not going to be terribly generous on the assumed entry. And then at the same time, let's sell the 24th of October 111 call. That looks like that's trading between 305 and 320. Let's say we're a little bit more generous here. Let's say we're able to get 315 on that trade. So what are we doing here? Well, we're spending 380. That gives us the right to buy shares for 110. At the same time, we're selling a contract for 315, collecting a premium, being paid 315. That gives us the obligation to sell shares at 111. So we have the right to buy at 110, but also someone else can buy those shares from us for 111. Hey, if we buy at 110 and sell at 111, that would be a $1 profit. If this were a free trade, it's not a free trade. If we're spending 380, collecting 315, what's the net between those two? That, to my maths, is 65 cents. The net debit also equal to the theoretical maximum loss on this trade. That word theoretical is going to play heavily into this discussion. Okay. Let's say that looks like that's 65 cents. What does that leave as the theoretical max gain? Well, if we ultimately exercise our right to buy shares at 110, and the other trader ultimately exercises their right to buy those shares from us, or assign those shares at the 111, buy at 110, sell at 111, that would be a $1 profit, but it cost us 65 cents to set this trade up in the first place. So it leaves us with 35 cents of profit. Mary Burns is asking the key question, and I'm going to put a heavy emphasis on this. Is there a concern of immediate assignment risk? Assignment risk is always present with short options. Out of the money, in the money, close to expiration, distant from expiration. It's just there are scenarios where the assignment risk can go up. The early assignment risk. Generally, the deeper in the money the contract goes, and also the closer we are to expiration, the higher that early assignment risk, right? So is there a concern? Yeah, there's a concern, but this is a covered position. And actually, Mary Burns, let me phrase this way. What do we want to have happen here? Actually, assignment would lead us right to maximum gain. I know that assignment feels like a scary thing. It almost feels like, aren't we always trying to avoid assignment? Well, if that were the case, maybe we wouldn't even want to do this in the money short option. I'll tell you what would happen in this unlikely scenario. Let's suppose we place this trade. It still has 22 days till expiration. We go to bed. It's Thursday. We're thinking we have weeks before we even have to think about assignment. And overnight, this trader says, I want Cameron shares for 111, and they buy them. What might I do when I wake up in the morning? Oh, you want my shares for 111? Fine. I'm going to buy them for 110. You can have them for 111. That's a $1 gain on a trade that cost 65 cents. We've now realized our gain, and it didn't take 22 days. It took 1 day. Now, that obviously that's it's not a very highly likely scenario, but it is possible. So that's a great question, but the word risk, I don't know. That's kind of a that's a word that may be applied according to the scenario. I wouldn't necessarily consider this a risk of early assignment when it may be the trader's objective to be assigned. Yeah, Greg says if only it worked that way. Every once in a while it does, Greg. Every once in a while, a trader in a spread just like this might get a little pleasant surprise when they wake up on a Friday or Tuesday or whatever. However, assignment risk doesn't always work out that way. It's a different scenario if we let this get to expiration, and that's what I wanted to talk about today. Getting assigned before expiration is one thing because this is a covered position at that moment, but not always. Let's suppose let's see. Actually, bear with me for just a moment. I'm going to pause on that thought. I need to use very careful language here. I'm going to switch from assignment to exercise. All right? No, actually, let's talk about this scenario. What may happen if, exercise is what I want to talk about. Let's suppose, okay, RBS says, could you show the chart again briefly, please? There we go, RBS. Yeah. Let's suppose that we allow this to go to expiration because the stock is where we need it to be. And so as long as we're just up above 111, this seems to be fine. What if though it sneaks below 111 at some point and it hits expiration. Mary Burns says, appreciate your clear explanation. Good. All right. Let's talk about assignment and exercise at expiration and how this can change very dramatically. All right. But actually, before I do that, hit the pause button again. My apologies. I want to make this one set up to sting. Okay. And actually, I'll have to apologize. At the outset of the webcast, I said long call spread alert, avoiding accidentally selling. Actually, it's actually only buying shares that we didn't intend to buy. Anyway, with that little adjustment made, let's set this up to give the trader more risk than maybe they intended to do. And let's go to our trade tab. And looking at the actual bottom line here, if this is costing us 65 cents to do a trade, it's not much money, is it? 65 bucks to do one spread. So our trader might think, well, geez, I could afford $65. I could afford $130. Maybe we could afford even many multiples of that. So let's say that our trader decided, boy, if I really wanted to exaggerate things, in this webcast series, we typically limit our risk on a trade or our investment on a trade to $4,000. Well, on this narrow spread with only 65 cents cost, let's divide $4,000 by 65. That leaves us with, how many contracts could we buy here? Paul, it can be confusing when you first start learning about options. I'll try to talk through that expiration risk that I'm talking about in just a moment. But look at this. Could we buy 61 contracts? In other words, if we bought 61 spreads times $65 per spread, that's a $3,965 investment, a $3,965 maximum theoretical risk. Okay. Let's just round it off just to keep round numbers. Let's say that our trader decides to do 60 contracts. What alarm bells just went off in the heads of just about every veteran trader here as I say that? So here's what we might do. Let's go to our spread single. I'm going to change this to vertical. I'm going to look at the let's look at our 110, 111 strike pairing, and let's click on that ask price to buy some call verticals. But instead of buying one or instead of buying 10, just to make this point, to drive it home, I'm going to buy 60 of these things. Right? Let's say that we're willing to spend up to 65 cents per share on 60 contracts. And let's click confirm and send. All right, let's click confirm and send, see if we can get a quick fill. I'm going to buy 60 of these verticals, 65 cents each. Hey, maximum loss, only 3,900 bucks. That sounds fine. There's significant commissions when we start doing multiple contracts on multiple strikes. Yeah, that can add up. So this might bring our total cost up to closer to $4,000, but still inside our risk tolerance. So I'm going to send that order off. Let's see if we can get a fill on this. Let's go to our working orders. Offering to pay 65 cents. Ooh, maybe I'm being a little bit demanding here. It's trading at around 63 cents. I'm a little bit above the mid, but not much. Oh, look at that. We got filled. All right. Now, as I was placing that trade, what was going off in the minds of so many of you veteran traders? Cameron, 60 contracts. Let's be real about this. We no longer have the right to buy 100 shares and maybe sell 100 shares. We have the right to buy 6,000 shares. Okay. Paul says margin interest of $660,000. Not yet, Paul, because we paid for this spread. So there's not margin on this yet, but what could happen? That's what I really want to talk about. Let's talk about this somewhat unlikely, but still certainly possible scenario at expiration. I'm going to clean up my chart just a little bit. We know that if the stock is up here above 111, at expiration, what's the most likely scenario? Well, we have the right to buy at 110. Someone else has the right to buy our shares at 111. shares are worth more than that, so we both do that. I buy at 110, shares are sold at 111. That's $1 made on a 65-cent investment, so leading to a 35-cent profit per share on 6,000 shares. On the other hand, if our stock collapses, if we come down here, let's say we're down at 108 at expiration, I have the right to buy shares at 110. They're not worth 110, so I don't do that. Someone else has the right to buy shares from me at 111. They're not worth 111, so they probably don't do that either. I always have to say probably because there's always there's the potential for someone to get a wild hair to do this. But in any case, most likely scenarios, the whole thing just expires worthless and we lose our $4,000 investment. But here's our big risk. Let me remove this drawing. Let me say our stock falls, but in between these very narrow strikes, we didn't think this could happen. Can happen. Let's say that our shares at they're at 110.50 at expiration. So, well, we can buy those shares at 110 and they're worth more than that. So we do that, right? And we're thinking, well, that's good because someone else is going to buy them from us for 111. No, they're almost certainly not. The shares aren't worth 111. They're only worth 110.50. And just because someone has the contractual right to buy shares from us for 111 doesn't mean they're going to. That contract very likely expires worthless. And all of a sudden, we just bought 6,000 shares that we never intended to buy. Oof. Can you say oof? I can say oof. That's a big deal. So how might the trader sidestep this? Well, one thing is the trader might place a smaller order. Another step that they might take is to have an exit order in place to get out. Now, you might be thinking, Cameron, there's no way. If this is going down below 111, we're getting toward expiration, I'll just go in and close it out. Okay, probably would. But is it possible, is it conceivable that we put on a trade like this and we forget about it? And maybe. Is it possible that we get sick? Is it possible that we go on vacation and we're otherwise distracted? When we're doing lots of options trades, how easy is it to just let one slip through the cracks? So what I wanted to talk about was putting in an exit order just in case we've gotten close to expiration and we don't want to let this get all the way there. Paul says, didn't you say this is a covered trade? Well, theoretically is, Paul. It's covered as far as the short position is concerned, but the long option can still be exercised. If this gets to expiration in the money and we haven't left, like, let's say, explicit instructions to do not exercise, the contract just gets assigned on our behalf. Yeah. So we thought we had the right to buy the shares, but we didn't have the obligation. True. Accurate up until expiration. At expiration, all in the money contracts are automatically assigned unless there is an explicit standing do not exercise order. So we could call the trade desk and leave that order. Another thing that the trader might do is do this. Let's go to our monitor tab. Let's look at our XOM position. I'm going to put it in order to just close this thing out last day of trading. Unless, if I've done it before then we just cancel this order. But I'm going to right click on XOM and create a closing order to sell those verticals. All right, now I don't want to sell the verticals right now. I just paid 65 cents for them. They're worth 60 cents at the moment, but if we're getting close to expiration, the trader may want to, it looks like I'm getting a little reminder here. That's okay, I'll deal with that later. Anyway, if the trader's getting close to expiration, they may want to have an order in to just close the position out regardless of the scenario. So here's what they may do. I'm going to put in an order to sell our vertical spread at a future market value. Now, I don't want I don't want that order to go into effect right away, sell the market or sell at the market right now, but we can actually submit orders at a prescribed time. So let's put in an order for, we could put it in the day of expiration. We could put it in the day before expiration. So if our expiration is the 24th, what if we put in an order on the 23rd to get out at whatever that market price is at that point, unless we've chosen to exit it before, right? This order will not go into effect until the 23rd. Well, I'm going to put in an order here in the mountains of Utah. The market's open at 7:30, and this is a local time. I'm going to give it, let's say, an hour and a half for that wide volatility to settle down. Let's say I put this in at 9 o'clock local time. That would be 11 o'clock Eastern time. This, you'd have to adjust this. A trader would have to adjust this by their own time zone. You have to know when the market's open. But let's say that our trader just prefers to let things settle out Thursday before expiration and then put in an order to exit. Okay. I'm just going to save that order. Let's click confirm and send. So explicitly what this order is doing is we're selling at the market price, whatever that may be, 9 o'clock Thursday before expiration, to close out this position. Now there would be a credit if this order fills. Pardon me, there would be a commission if this order fills. I'm going to send that order off. Now that's a trade that a trader might place if they don't 100% completely trust themselves to be attentive to a position. Obviously, maybe a better idea is to just pay attention on a regular basis. But are there ways to automate an exit to avoid that potential exercise risk at expiration? There we go. HCO Keith says, how easy is it to add those do not exercise orders? You just call up. Let's see. I think we've covered everything. Guys, that's what I wanted to discuss today. Now, every once in a while, I can trip over my tongue when I'm excited about a topic. And at the outset of the discussion, I talked about selling shares we didn't intend to, or selling shares we don't own. The risk here I actually want to talk about was buying shares we don't intend to own. In any case, got it accomplished. This is what we do with these Thursday webcasts. We talk about trading long call vertical or trading long diagonals and long vertical spreads. We talk about the management of those. If you enjoy this discussion, you're certainly invited to join me again next Thursday to follow up on these trades and others to come. Also want to invite you to join me and Kevin on X. You should be following your favorite presenters on X. It's the best place to connect with us in between these live streams. So you can find Kevin on X at Kevin Horner CS. You can find me there at Cameron May CS. And if you reply to one of my posts, I try to reply right back to you. It's where I can have discussions when the camera's off with my followers here. So just as with subscribing to the channel, it doesn't cost anything to follow us on X. But you can reply to things like, hey, why would some traders not consider this to be a legitimate inverse head and shoulders pattern? So people have been replying to that post, and I've been having that conversation with them. Everybody, if you didn't do this yet, also make sure that you are subscribed to our Trader Talks channel. So you can go down in the lower left-hand corner, click on the subscribe button, or you can go down below the video stream, click on subscribe. It only takes a second, doesn't cost anything, but this is where we house our playlists for previously delivered webcasts, and you can join our live streams here. But Trader Talks Schwab Coaching Webcasts is the channel name. Just track us down there. All right, guys, thanks to everyone for joining us today. Thanks. We've got about 200 people watching the live stream, and I can see 52 have already clicked the like button. That's very much appreciated. That's just like a pat on the back to your presenter. It also gives a boost to the presenter's video in the YouTube algorithm, helps more people find these videos. So thanks for doing that. Kevin, thanks for helping out in chat. Definitely appreciate it. Everyone, I will see you in a future webcast. Now, did I just notice, Kevin, a survey? Was that a survey link? Oh, there is a survey link. Thank you. Thanks for reposting that, Kevin. Yeah. So everybody, I suppose a final request is to click that survey link now. Just 2 multiple choice questions, a comments box and a suggestion box. But I promise you this, if you take the time to fill out our surveys, I take the time to read through all those comments. I read through that data, and it always helps. It's never a wasted effort. So thank you for doing that. I will see you in a future webcast. I'll also look for you on X, but whenever I see you again, till that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.